Thank you for joining, everyone. Really excited to have this session today here. By way of introductions, my name is Usman Gul. I'm the founder and CEO at Metal. Before starting Metal, I raised 120 million for my first startup, Airlift, and was also part of the early team at DoorDash and Marqeta many years ago. This event, as you all probably know, is hosted by Metal. We're backed by Andreessen Horowitz and Y Combinator, and we're building a platform that is becoming the default operating system for founders that are raising venture rounds. Today, with me, we have here Paul, who founded Gaingels in 2014. A little bit about Paul. He has deployed $900 million across 1,500 companies, 75 plus unicorns in the portfolio so far. Given that experience, Paul brings a sharp eye for what separates the top founders and so we'd love to, take a moment here and just invite Paul to introduce Gaingels and himself in his own words, and we'll subsequently move over to our second speaker. Over to you, Paul.
Happy to. Well, as you said, I started Gaingels. Before that, I was a founder, started a couple of companies in college and grad school, and was lucky to have some success with those, and did a bunch of early Bitcoin, Ethereum investing, and then semi-retired after that. So it was my 2009 to 15 era and my founder era, so to speak. And then started Gaingels in 2015. We're actually a little bit larger now. We're a bit under 1.4 billion deployed in 3,000 some companies. So, but we don't publish the statistics too heavily, perhaps on purpose. We want Gaingels to be kind of a large, semi-silent but deadly ecosystem assisting our founders. We're known really for three things. We're known for obviously being the leading investors representing diversity and inclusion on cap tables, and also for helping our companies recruit a lot of talent from different backgrounds and experiences. And then we're also known for having a really deep Rolodex of members and other associates of ours that are at different customers and potential business development partners for startups around the world. And we're known for being very active but non-lead. And so we are a non-lead co-investor alongside top VCs and strategics in companies. We write a check. We tend to write subsequent checks in future rounds as a supportive insider. And then we help out with the Rolodex and the representation recruitment side. So that's us in a nutshell. The other interesting stat about Gaingels is we have well over 80 unicorns, but 40 some of them we actually invested in before they were unicorns, and we invested in 10 of them at the seed. So we have some nice track record, thankfully, in sort of helping cultivate founders to grow to that point in their journey, not just backing them when they're already unicorns.
Awesome. No, I mean, that's an incredible track record, Paul. Thank you for sharing that, and really excited to hear your perspective today. We also have Cameron Peake from Restive. For a little bit of, by background, Cameron is a partner at Restive Ventures, where she backs early stage fintech founders building the future of financial services. Restive has made a little over 50 investments, and they recently closed a new fund that's focused on seed and pre-seed. Cameron and I, we've known each other for more than a decade. But we recently reconnected after a while, and Cameron would love to sort of invite you to introduce yourself and also introduce Restive.
Yep, great. I know, and it's so fun to reconnect with people you've been on the journey with for 10 years. So I'm a partner at Restive. I started about 4.5 years ago at the start of our fund too. And my whole career before then was on the operating side. So I was most recently the co-founder and CEO of a company called Aslo, or digital bank for small businesses. I grew that to about 150 employees and nearly $1 billion in deposits. Before that, rolled up and sold to PNC Bank, did fintech and emerging markets prior to that. So really bring that depth of operating experience within the fintech realm. And yeah, I look at Restive as kind of an interesting kind of perspective coupled with Gaingels. So whereas Gaingels is broad, kind of multi-stage, we're very specialized in early stage. So about 50% of our deals are at the pre-seed stage, so kind of true pre-product, 50% at the seed stage, so super early within fintech. Our aperture is quite broad, and so we'll talk to a ton of companies, but we really do want to bring that kind of specialized expertise that we have to fintech investments. So again, we'll come in super early, we roll up our sleeves, we work alongside of you. Our initial check is typically about 500K, and then we'll build from there. And so given how early we invest, we often see, and I know we'll go into it, those early micro signals that will kind of drive us to put a first check in and grow from there. And we actually have about 80 companies in the portfolio, one that has IPO'd, a couple that are kind of unicorn status as well. So although our denominator is smaller than Gaingels, we have seen some of those breakouts as well, and excited to get into it.
When I
Yeah,
think
absolutely. And just
Gaingels
for
and Restive we're very different, but also that they're exactly the type of fund we collaborate with quite
Yeah.
often. Angels is sort of a complementary supporter of highly specialized funds, where we bring, kind of a generalist expertise and a wide network and the ability to kind of open doors, and they bring much more of the functional diligence expertise and sort of focus on a much narrower range of companies.
Yeah, no, that's excellent framing. That's exactly why, it is actually very intentional on our part to bring together different investors with very different investing styles and very different sort of round dynamics. And so, the check size, everything's, it's just significantly, different for Gaingels. I think the check size is smaller. It's a larger number of investments. I guess just to frame today's conversation, right? Like, we were looking at some of the statistics around fundraising, and we actually published this on LinkedIn a couple of weeks ago of thousands of rounds that we've seen happen, on the Metal platform. We're seeing success rates of all founders that go out to try and raise rounds across all stages. We're seeing success rates between 8 and 15%, slightly higher at Series A, slightly lower at pre-seed. But of all full-time founders that are fully focused on raising rounds, that's generally the success rate. The question there becomes, well, when you're looking at like pre-seed companies or even some seed stage companies, there isn't a whole lot of metrics to evaluate the business on, right? Like a lot of these companies are pre-revenue or minimal revenue, right? If there is revenue, it's like, their friends and, people they know that are using the product, right? Sometimes there's a clear sort of, some level of maturity in the product. Oftentimes there's, just an MVP, a very, very basic sort of, version of the product. And so, a lot of these early stage investments tend to, focus on the team, the founders, right? And, one of the things we want to focus this session on was what are things that distinguish the top founders that, consistently, you guys end up backing for their first company, second company, whatever it may be. And this is intentionally broad, right? You can take this in any given direction. But Paul, we'd love to start off with you, right? I know Gaingels is a different strategy. It's higher volume, it's smaller check sizes. So from your perspective, right, like when you're looking at these early stage companies, what are really the things that you're, looking at, and specifically with a focus on like founders? Like what are those qualities or those characteristics or inclinations of founders that you find yourself drawn to when Gaingels, the firm, is investing?
Yeah, so I'll answer that in two parts. So one is, we tend to be an investor where we make a lot of early bets that are smaller, typically 100 to 500K and sort of the pre-seed, seed pre-A most of the time and then we have our scout fund that's smaller than that. And then we tend to write larger checks, which can be anywhere from 250K up to like 10 plus million. And 1 to 5 is fairly standard in sort of pre-Series A, Series B, Series C, Series D. And what happens with us is, in the pre-seed, almost 100% of the investments are net new, except for founders that we backed before, where it's a net new for that company, but we know the founder. When you get to the seed, it's probably 75% net new. Then by the time you're getting to the Series A, it's probably half new, half existing follow-on companies. And then by the time we get to Series B, it's 2/3, maybe more follow-on, 1/3 net new, and Series C and later it's almost all follow-ons. And so where I'm going with this is, there are certain things we look for on the founder side, in terms of characteristics and style, and I'll talk about that in the second part. But I'd also say that you don't know what you don't know. And so if we haven't known the founder before, we're looking at those characteristics, but we're also aware that, maybe 1 out of every 25 or 30 of our pre-seed companies are going to be like a unicorn style hit, maybe less. And maybe 1 out of 10 of our seed companies will get to be a several $100 million company or unicorn company, maybe less. And then you start to get Series A, Series B, it's more like a third or so. And then, Series C and later, you're kind of already in that territory. So it's really about what's the exit outcome. You start to model out the more realistic exit outcomes. And so with that in mind, I think we really look at it as there are certain characteristics that we're interested in, but also we don't know what we don't know. And so we want to see the founder progress. And so if we can write a check in the pre-seed or the seed and then continue with the check in the pre-A or the A. By the time we're getting to the A, B, we have a lot of knowledge in the underwriting of like, how does this founder actually like build? How do they interact with customers? How have they grown the ARR? How do they report back to investors? Do they ask for help? Have we found that they're really good at what they do, but also coachable? So those are things we look for. I think when I'm first meeting founders, there's a few aspects that come to mind. We spend a lot of time on, obviously, what's their previous track record. So if they've sold a company successfully and/or they've raised venture funding before and the company had a strong premise, obviously it's great if it worked out. Sometimes the company doesn't work out, but it can be just based on, the market changed or, who knows. But having had some previous track record success is valuable, but by no means is it required, but it's definitely something valuable. Second, we look a lot at, if they didn't necessarily start a startup before, but they worked either at, maybe Tesla or SpaceX, or they worked at another, highly successful growth company. That's super valuable to us, kind of having founders that have had some experience in one of those environments. If they're younger, maybe in a junior role. If they're a little more senior in their late 20s, 30s, maybe in a more medium or senior role, is really helpful. And then we also look a lot at educational pedigree and background. It can be very important. And then just founder demeanor. It's interesting. This is a bit of an amorphous answer, but I do find that, like, and maybe just because I've been doing it a long time, and like I'll talk to founders and I'll get a sense of like, is this person, secure in their self? Do they understand like what they're doing? Do they understand how to run a business? Do I feel like, when the crisis hits, they're gonna panic or they're gonna like sit as a deer in the headlights and let it all fall around them? Or do I feel like they're gonna like hunker down, figure it out? And you don't always get that right. I mean, there's definitely been some founders that I thought really had it together and then crisis hit and they definitely didn't. But I do think I'm gradually getting a better sense of that. And so I really look for, I guess, what I'd call those founders that have some of the right experiences in their both education and their career path, but also where I just get the sense that they understand their business, they understand their market, they know what they're doing, and if and when the crisis hits, they understand how to process that. I think also, Gaingels is itself sort of a startup, and I was a founder before that. And so, I've gone through a couple of crises myself. And so, having seen how I reacted to that and how I managed it, I kind of look for something similar in founders. That'd be my initial take.
Right on. And I mean, there's so much to unpack there. I'd love to come back to this, Paul, especially the crisis part. I think that'd be very interesting. But before we do that, just I'd love to, Cameron, I'd love to go to you. What is I guess I'd love to start with like sort of uh, your perspective on the same, but also has your perspective shifted over the years? And if so, in what ways? And this is, not just like your personal perspective, but also for the firm, for Restive as a whole.
Yeah. And I'll say what's interesting, Paul mentioned kind of getting to them early and kind of observing over time. And we have somewhat of a different strategy to do the same thing. Like we don't invest post Series A, but what we'll do is we'll put in, as I mentioned, about a 500K first check. We're in the trenches. And that's enabling us to, one, get to know the founders a lot better, and two, seeing when product market fit occurs, what product velocity and sales velocity looks like, and we'll kind of build from there. So we're making decisions in a very, very compressed time frame, but the idea is similar, right? Like how do we put in some sort of check with very, very little signal up front, and then how do we gain some conviction over time? I'd say the three most important things that I look for. The first is it's really in our name. So we chose Restive basically as an homage to our most successful founders. And the way that we see it, they're people that are severely dissatisfied with the status quo, with something in the environment today, and they want to solve it immediately, right? And that level of being impatient, of urgency, of complete dissatisfaction and obsession about a topic, that is exactly what we look for and what we've seen in our most successful founders. And so the one big piece is ability to move fast. That's coupled with a big vision for how the world should change. And then kind of to what Paul was speaking about, there needs to be the belief that this is the right team to do that. And so sometimes it's, they've been in industry for a while. Sometimes it's, they were working in some job and like there was something that just grated on them. Sometimes it's even kind of earlier in their life cycle, but there needs to be some sort of proof that this is the team to execute across that big vision with a big sense of urgency. So that's really what I'm looking for up front. Like you desperately, obsessively want to solve a problem. It's a big problem and you have a big vision and you're very ambitious to do so. And whatever characteristic we want to look at, you feel like you could be the right team to get there.
Right. I mean, I love that, right? I think the obsession part, the part about obsession with the problem, right? Like I think it's this almost like visceral feeling that, hey, like this problem is so important, like, this is like, why aren't more people working on this problem, right? Like, I think symptoms of that is like, you're deeply knowledgeable about the problem space. You've thought about the problem at a very, very deep level. You can talk for hours about that problem. Because you've thought so deeply about a given problem, you bring some sort of a unique perspective. There's so much there. But, in your experience, like what's been sort of some ways in which you're able to decipher or sort of perceive that obsession with problem and to be very specific, how do you distinguish that from a deep interest? Because like anyone who starts a company in a given space, they have a deep interest in that category. Yeah.
It's subtle, and I'd say there's two ways we look at it. So the one is that first check, right? And it's harder to tell kind of deep interest from obsession. I will say in our most successful founders, you just get it. Like they want to go deep on some brand. Like we have one company now, and the founder is obsessed that we should rent everything instead of buy it. So it's like a modern leasing company, and it just jumped through this guy was like 24 and just obsessed with this topic, and he'd worked on it in different iterations, and there's a big vision for how the world should change, and that jumped out of our first conversation. I'd say in many cases, it's rarer for it to jump out early as much. And typically that's where it evolves over time. And so as we're working alongside founders, we start to understand at a deeper level, is this, yeah, just kind of a passing fancy versus is there some really intrinsic drive for you to solve this problem that's going to motivate you for the next 10 plus years? And that's something that kind of reveals itself over time. So it can show up in a couple of different ways. I'd say it's pretty rare that it just screams at you as part of a couple of first conversations. In some cases it does, and it's so intangible that like I can't even tell you. You just sense like every fiber of their being is obsessed with this topic.
Right on. And how many like on average or typical like how many conversations does Restive have before getting to an investment decision? Like how much time you guys have to sort of
Make
form a
that
point of
decision.
view?
Yeah,
Yeah.
yeah. It's honestly it's pretty fast because what we see at this stage is again the best founders are also moving super super fast. And so the way that we typically operate is there are three partners. You speak with each one of us, 30-minute conversation. In some cases we stacked it in a day or two. It's not the best practice, but we've done it before. In some cases there's a fourth, but we're making those decisions really quickly because again a lot of it there's not a lot of data we can get at this point, right? There's not a lot of overthinking we can do. So are these three pieces kind of met? Obsession, big market, right kind of team to get there. I'd say beyond that, I think we'll go into some of these things later, but like what needs to be due risk because we're fintech experts. We know what have been the, kind of failure paths before. And so in some cases, we just need to wait and see longer. But we can get there pretty quickly. And then the majority of that discovery happens working alongside the founders post initial investment.
Right. I think the common thread between what Paul, shared and Cameron, you're sharing is sort of observing founders. So this idea or this sort of notion of observing founders. And sometimes it's like running a $500,000 check and then seeing how things progress. And sometimes, like Paul mentioned, right, it's like, making a bet in pre-seed and then sort of following along the company along the way as the company moves into seed and Series A and Series B and so on and so forth. But Paul, coming back to you, what are sort of ways in which you're seeing founders sort of get creative and thoughtful about enabling angels to sort of observe their company and sort of observe their execution before, there's an investment, right? I guess for all the founders on the call and everyone else who's going to watch this, are there creative and thoughtful ways in which founders can enable investors to watch their progress and observe their progress over a given time period, even when, you're not an investor in the company?
Well, I'd say for Gaingels, we tend to be pretty fast moving from when we first engage with the founder, if there's a round opportunity happening where, because we're not a lead. So, if that's coming together, if we talk to them and the round is not yet coming together, we often help them with introductions to leads and potential strategic follow-ons as part of our process as well. We're interested to see, are those folks interested in talking to founder? How does the founder handle those conversations? What's the feedback from the VCs we introduced, right? So we help out with that partly because we want to be helpful, and also partly because it's really good data for us. I would say a lot of times the opportunities that we have for learning tend to come during our kind of post first investment, pre double down, triple down part. Like, and a lot of times that comes from, I'll have conversations with a lot of my CEOs once a quarter, once every 6 months, kind of how they're doing, what do we see in the market? What do they see in the market? How's their strategic approach working? And then we'll chat through kind of, learnings that they might have, things that we might be able to provide insight on based on what we're seeing ourselves or what other companies are seeing that they tell us. And so I help founders a lot with that, kind of in a kitchen cabinet advice sort of way. And then also we help with a lot of introductions on the customer and biz dev side. And so, there's a real value in, like, you invest in a seed. We would put 250K at a seed, right? And then the company's looking to grow to, its first million or two in ARR. And we introduce them to 5 potential customers. And I go get, I always ask for feedback from those introductions on how did it go? How did you find it interesting? What was the next step? How did the founder, kind of like push the conversation? Did they suggest talking to one of your colleagues who's closer to it? Like, what, how did they do the sales process? And so that gives us a big observation. Like, if we do a small seed investment and then we introduce 5 or 10 potential customers and none of them pick it up and they all have different, challenges, then probably not likely to reinvest unless the company, unless I talk to the founder, they're like, yeah, we learned a lot. We pivoted to here. We're doing a lot better with this. And, this VC's backing us and we'd love to talk to these new customers, with this new pivot. I mean, then that can be a different approach. I mean, founders pivot all the time. But if they're just banging their head against the wall and not really breaking through with people they're connected to by us or by other people on their cap table, then that's also a sign. So I think I would say, and it's interesting because the top 1% of founders is sort of an interesting kind of in between stat, right? Because I would say out of, I've probably talked to, I don't know, 20,000 founders in the past, 15 years or so. And I've invested in several thousand of them. And I'd say there's maybe 100 of them that I can think, I had that conversation and, like, I knew that person was going to figure it out. Job from Remote comes immediately to mind as someone, like, we did his seed with Sequoia, and it was just like, it was like immediately clear that, like, he was gonna figure it out. I don't know. He just, like, you could just tell that it was gonna, like, work out. Z from Remote.
Paul, I'd love to go one little lever on that. Like, what specifically led you to feel, if you can break, like, and I know there's no, like, black and white here, but, like, what part of that, what were the characteristics of that conversation that led you to believe that this person's just going to figure it out?
Yeah, I mean, this conversation was in 2017. We've been at Remote for a while. We did, I think, 3 or 4 rounds of Remote. So I don't remember the exact details like it was yesterday, but what I do remember feeling was just that this was a supremely competent individual who was really deep on this problem, really understood it from their previous experience, and was just someone that could execute well in a sales call, but also in a founder operational role, and that he was really able to put it all together. I'd say Z from Row is another one, and he just came off as someone who, like, deeply, deeply felt the problem he was solving personally, and really wanted to just absolutely, like, embed in it, and was going to figure it out one way or the other. And that was just very clear from, like, the first conversation. it was one of the easiest yeses we ever had. Andrew from Enable was another one where it's like you spoke to him and you just understood that there was a very deep level of operational competence. There was also a very good understanding of the problem that was solved, but like just very deep competence on how am I going to run things. And interestingly, there's been some conversations where I felt like a founder was strongly competent and I turned out to be wrong, but there's sort of like this very upper tier. I would say it's not even 1%. It's more like 0.2, 0.3% of founders I speak to where like it's just clear and I just write a check and that's it. And I try to get as much as possible in. And then there's another tier below it, and I would say that's maybe more like top 3 to 5% of founders where I feel really good about it. And I would say it works out more than half of the time, but like about half the time ish. These are all ish numbers. I don't want to like be quoted on it in a court of law. But but for those, still half are failing. But obviously if you have a really good feeling about it and half of them succeed at like a Series A or before level, you're doing great statistically from an investment perspective. This is not you're not trying to bat 700 in venture, you're trying to bat 200 with some unicorns. Yeah. And so anyway, where I'm going with that is just the top 1% of founders, at least to me, is sort of an interesting concept because I think it's a great question to ask, but it's also like, to me, it's almost like there's the top 0.2 or 0.3% of founders. There's the top 5% of founders. And then maybe a quarter of the founders I talk to, I feel somewhat good about, but have some questions. We do some of those. We pass on a lot of those. And then there's like 75% of founders I talk to where I'm just like, I don't think they have it. I don't think that the premise is right. I don't feel like they have the right experience. I don't feel like the stats are there. Like, it's just not something I want to be doing. And interestingly, that bottom 75 to 80% also feels fairly clear to me. I'd be very interested in Cameron's feedback on this too, but I feel like it's like the top 0.23% is abundantly clear. The bottom 80% is clear. And then where there's a lot of hazy struggle is in that like top 10 to 20%, which of the, if you're looking at 100 companies, I could tell you where the top three of which 20 the top three will come from, but I couldn't necessarily tell you which 6 the top 3 will come from. And that's the struggle. You have to figure out that part. We tend to take a little bit of a volume approach to that struggle, but that's by no means the only solution.
Yeah, I mean, this is really interesting distribution. Cameron, I'd love to also get your perspective on what are you seeing in the distribution if you look at, high level over the past few years?
So let me tell you how we've modeled out our portfolio and what the data has shown so far. And that's the crazy thing about venture, coming from the founder world. Your feedback cycles are so long. So like when you're building something, you have a thesis about a product, you build it, you put it out, it works or it doesn't, you iterate. Like this, your feedback cycles are 10 plus years, which is crazy. And you get all these intermediate things that can be highly correlated, but not perfect. So I mean, the way that we look at it from a portfolio construction standpoint is we invest in 30 to 40 companies over the course of a fund. We are really looking for one to be IPO kind of $5 billion outcome plus level. And that makes all of the math work. It's exactly what Paul was talking about earlier, right? Like we're not looking for high batting averages. One makes your fund work. Within fintech, there's a lot of interesting things going on where you see a relatively high frequency of kind of high value M&A. And so we basically model out 2 of those deals, which are 300 million plus exits. And so we've seen that occur fund over fund, where basically 1 out of 40 is a very large outcome. And then there's 2 that, produce, call it a 5 to 10x for us on a deal. And so we've loosely kind of tracked against that over our prior 3 funds. Going back to your analysis though of kind of the buckets, Paul, I agree that the trickiest ones are those that are kind of in the middle. So there's a whole wash of things where for whatever reason, it's everything from this is a good business idea, it's just not venture scale. That's probably the biggest one, right? Like a lot of people see a problem, it's a really good idea, but we need to underwrite things to 100x when we're talking to them. And that means like a very massive TAM that's not complicated to get there. And oftentimes, I can see some, kind of $50 million a year business, which is awesome. It's just not aligned with our capital strategy. So that is by and away the biggest bucket of things. Yeah, and the tricky ones are those where it's not this obvious home run, big vision, right team, and it's not small town, kind of wrong founder profile. That bit is quite frankly where we spend the most time debating. Um, and at some point we've just gone through kind of the analysis is that if we're not moving quickly on this and there's nothing obviously wrong, it's a no. Like we're just kind of over analyzing, and those have never worked out for us. But yeah, those are basically kind of our ratios and how we think about the portfolio construction.
Yeah. Well,
I would
alongside
piggyback
that,
on one. I would piggyback on one thing. I don't know if Cameron said exactly this, but I heard a gist of it in some of your earlier thoughts, which I agree with, which is that I probably know the founders I really like and I want to back. I probably know I want to do it in the first 10 minutes of the conversation.
Totally.
And if I'm hitting minute 20 and I'm debating it with myself and I'm overanalyzing it, it's probably no. And if it is a yes, I'm probably going to regret it. Generally been my experience.
right. First 10 minutes, they matter the most. I guess statistically, I think there's a lot of statistical evidence around that. One quick question
Although I think
around,
it's often misunderstood what that means. Like for me, for example, like I have a reputation for being 3 minutes late to every meeting because like I have to like get one founder off of Zoom, find the other Zoom, come on. I often like to like take my pitches while walking on the beach because I live in
So you only have
Miami.
7 minutes? Is that what we're saying? The first, you only have 7 minutes to prove yourself?
It's 10 minutes from when I get on. But yeah, but like, so I think sometimes people say, oh, well, that means, it's about the founder being like super like polished and buttoned up and ready. And for me, it's not always that because I sometimes gravitate to sort of more free spirited personalities. It's a lot more about just, do I get a sense from their demeanor, from their knowledge of the material, their knowledge of the problem, their background, that they are like the right people for this. They have the right depth on it, and they're going to commit to solving that problem until it's solved, but and that they have the chops for that. I don't know, it's very hard. Cameron, I don't know if you have the same experience. It's very hard to like give people like a cheat sheet and articulate what that means. You just kind of like, when you see it and when you see that person, you're like, yep. But it's hard to like say what you're saying yup about.
I think it's different in every case. Yeah.
right. I guess one really interesting question around this is that of social proof, or more specifically, maybe Paul, will start with you. How much does it matter if the founder has raised capital from other investors at the time that they engage you or talk to you? How much do you care about that? There's like on one end of the spectrum, there's like great funds that have a strategy to follow other larger investors at pre-seed and seed. And so their strategy is built around following on, right? And then there's the other end of the spectrum where it's like, we actually like companies that don't have any investors on the cap table or have only like, some early stage accelerator or whatever. Paul, where does Gaingels fall on that spectrum, particularly for pre-seed and seed? How much do you care about social proof?
It's a great question. So I'd say, Gaingels, we participate in rounds that are coming together that someone we like has to be leading, right? Because we're not going to lead it. Um, so there is that, although we often will engage with companies prior to that, get a sense of them and introduce them sometimes to those folks. Or maybe they'll find the lead on their own and we'll introduce a strategic helper or one of their co-investors, et cetera. So we can be somewhat active participants in that process. We don't really want to be engaging like late in the game. We often like to engage kind of whenever we're introduced and then help out and then participate. The other piece is that I think when we first started, it tended to be a lot more signal focused to a few funds. And I think as we've evolved, um, we want to be investing with folks we like, but that aperture is more varied. We do a lot more work with 8VC than we used to, which is a great fund and certainly a big name, but smaller than say General Catalyst is. We do a lot with other smaller VCs, like NFX comes to mind. We do a lot of work with we've done a lot of work with Spider Capital, which is a very great sort of specialist software cyber firm. We've done a lot with Lackey Groom, who's got awesome founder networks and has been a great friend to us over the years. Like they're just like, I think it's so there's a value in social proof, but for me that the investors that can make up that social proof is grown. It's also different, based on what the company's doing. So if we're investing in a high growth seed or AAI company, there's certain funds that are going to be great for that. And then if you're investing in like a aerospace defense company, sometimes it's the same funds, but oftentimes it's different ones. So social proof is important, but I guess for us, we're not like we're not looking to follow just like pick a tier one fund name on every deal. In fact, I think sometimes like they're great funds, the really big ones with like the multi-billion-dollar AUM, but sometimes they can put really high valuations on companies, which can be challenging from like a return standpoint. And so sometimes we really love to get a check in before they come in. Like I love to like some of our best returns are things we put like 300K in like the pre-seed at like a 10 cap, and then it got discovered, and then we put $1 million in at like an 80 cap, and that still works out, but the seed part actually does a lot better or pre-seed. So
Right. So in summary, what I'm hearing is that there's nuance and strategy to following on. And it's not just like, oh, let's just follow these funds. It's more nuance, and it's there's a lot that goes into that. But the general idea is like you like seeing other investors on the table, but that is not a hard requirement. Cameron, how do you look at following on? Do you prefer that? Do you what's your preference?
I will say it totally depends, which is a really unsatisfying answer. We like being the first institutional check and setting pricing with some caveats. I mean, one is if a company needs to raise a ton of money, like they're building out an infrastructure company, like our 500K check is not enough, and we need to make sure they can raise, right? So that's an exception. I will say, going back to Paul, what you're talking, I would say when those large multi-stages have come in early, it's more often been a negative outcome. And I think one is exactly what you mentioned, right? Like for them, a pre-seed at 30 post is trivial, but the hurdles that you have to reach after that point are just so high that it doesn't really make sense with where the company is. The other thing that we've seen is oftentimes those rounds are so massive, and what you need at this pre-seed stage, again, for on average, is some degree of hungriness, right? And like if you have enough capital and you're not hungry and you're not pivoting quickly enough, that's the only advantage you have. And so we've seen those rounds that come in at 6 on 30 or 6 on 40 just to like have pretty negative outcomes as a general rule of thumb. And so again, like it's not to say we have drawn a hard line around not doing them, but looking back, those have typically underperformed compared to some scrappy $1.5 million round where maybe it's us and one or two other very small kind of specialist funds. Those have worked out a lot better. So again, the high level answers, it depends. If you need a lot of capital, we do want to see you can raise. Being able to raise is an important indicator of future success. And so it's not by any means a negative, but we also love being the first institutional check-in, getting our hands dirty, kind of helping, and to what Paul said, kind of introducing that founding team to the rest of the investment ecosystem.
I also think Cameron makes a great point around the creation of an artificially problematic waterfall and sort of the expectations that come with that. Like obviously would never say the company name, but we backed a company over the last few years where they raised like 10, they raised a million at like 12 that we first participated in, which was great. They were just killing it. Then they raised 10 at like 60, which was fine, but created some challenges. And they were still doing well, but wasn't growing quite fast enough. Then a big fund that I won't name, but they have somewhat of a reputation for doing this, came in and gave them 100 million at like a very crazy value, which did not make sense. This is an interesting like deep tech robotics company that was doing a few million ARR and kind of moving forward. And that just killed the company because they spent the money on like a bunch of stuff that wasn't really needed, and then they didn't grow as enough. And so they ended up in this really weird spot where at the end of the 100 million, they actually had close to 10 million in some revenue, and it was a decent company, but just the waterfall was so big, and that investor didn't want to do any kind of pro rata participation, that they ended up having to do a massive pay to play down round. And then they ended up actually selling the company after that. And the people who participated in the pay to play and were in like the early rounds like us did okay. We netted out like a 2x or something on all that. But, it would have been a much better outcome. Like could have been a 20, 30, 40, 50x for us and the founders, et cetera, if they had just avoided that really crazy round. And so it can be very hard for founders to like, a lot of times I think with founders, it's like, raise, and like more money is better, but that's not always true. And one has to think very like measuredly about how they want to raise, who they want around the table with them. Are those people going to support them in future rounds? One of the challenges with really big VCs coming into pre-seeds and seeds, I think, and Cameron, I'd be interested in your perspective on if you agree or disagree with this, can be that they don't care that much about those outcomes unless those companies are a little bit of a call option for them. If X big name fund gives you 5 million at a 50 cap, like they're just trying to like get on the cap table to see if you're going to get to the A that they can fund, right? And if you're not in the top 2-3% of their portfolio within a year and a half, they're probably not going to follow on, or they'll do like a partial pro rata or something, which is a super negative signal in the market, and it makes it harder. And probably would have had an easier time if you just raised 4 or 5 million from some specialists and good folks at a lower price, and then came to that fund for your A when you had more data. That's just my 2 cents.
We're 100% saying both as an option call, and then if you think about the market right now, seeds and A's are crazy, right? Like anyone who's had product market fit and some level of revenue traction, they're getting a ton of term sheets. And so the multi-stage strategy has been in recent years either a ton of money kind of pre-IPO, and we've seen that absolutely happen, and go early and earlier because the valuations are better if you actually pick the right one. That those returns look a lot better. And so you've seen a lot of these multi-stage funds go earlier as option value, and I think because of the intellectual pricing advantage. But Paul's absolutely right. And like oftentimes we'll be pulled into those deals because we do bring the early stage kind of specialist expertise. And we'll be talking to founders where we're on calls with them, every week, kind of talking through product roadmap or GTM. And the multi-stage hasn't talked to them in months. And they just want updates. And it is purely a capital relationship at that level. And oftentimes it's overkill and brings the signaling issues. So yeah, that's been a big reason why there's been a fairly negative correlation with having these multi-stages come into the pre-seed.
Right on. Those are excellent points.
The only last thing before I forget, and then let's move on, is that you always, as a founder, have to be aware too that like there's middle markets, there's very high bull markets, especially for early, which is what we're currently in, and there's down markets like mid 2022 through end of 2024, right, where it's very hard to raise capital. And so being measured about what you raise and being thoughtful about which investors you bring in and their incentive puts with you is very useful, because you want to make sure that those people will continue to support your rounds if the environment changes. And I would say that there is a definite significant risk that the environment will change in the next year or two. I wouldn't put it higher than 50%, because I think, things like the Cerberus IPO went well. There's other big companies going out. There's a lot of excitement, but there's a solid 30% chance that the environment could change. It's very hot. And so I think people just have to be really aware of that.
Yeah, I mean, this is such an interesting and powerful topic. I think there's a session we should probably do an event just on that piece, like overcapitalizing the company and what it does at a very tactical level, and the dichotomy of the perception you see on social media and the reality of what's actually going on in the company in terms of incentives and privatization and I think Cameron, you used the right word, hunger. What it does to a company's hunger, and in this sort of innate desire to win, I think is just a really powerful and deep topic. I know we're pushing right on time. We'll take a few questions from the audience. There's a few really good questions here. One of them is, hey, like if you really believe in what we're building and we're building something very, very special, like for an under network founder, what is the best way to get in touch with your fund?
I mean, for us, we all have our first names at the company domain. You can also reach out on LinkedIn or Twitter. We've definitely taken pitches there before. I will say, in general, if you do find a way in, like I definitely use LinkedIn and see mutual connections, because if you can get a warm intro, it's usually better. Like we get a ton of inbound pitches and we just can't work through all of them. So in general, if you have a target list of VCs, I try to find a mutual to get an introduction from. But our inboxes are open and we have invested in companies that have come in cold or through DMs.
We're mostly warm intro. We do also review the cold DMs, but there's a lot. So I would say getting a warm intro is super valuable. Also, like Gaingels is a rather, speaking only for ourselves, Gaingels is a rather large network. So, someone should be able to find a warm intro to us from one of our portfolio companies or one of our many members that put it on their LinkedIn. I think that tends to be, most well-networked founders will know someone associated with Gaingels, I would say.
Right. And just, adding my perspective to, what Paul and Cameron have reached, like, I personally get a lot of like inter requests, and like I can confirm 90% of them are like, I don't feel comfortable passing it along because I feel like it's not clearly articulated, or the sort of what's coming through is I'm not able to understand it. And I'm very sort of liberal and open, and I'm not here to evaluate companies, nor do I don't invest and so I think the best thing founders can do really is like sort of figure out the right sort of positioning and the right articulation and have that sort of clarity of thought on what problem you're solving and why. And I think that really matters. There's another really good question. First 10 minutes. Talk to us more about those first 10 minutes. And look, like I understand, right? Like there's like different styles that founders have, right? Some are, I saw like one of the best things that I saw recently in a session that, one of our investors, Andreessen Horowitz, did was they gave founders sort of aura profiles. And they they group some founders together and saying, "Hey, we think you have a professorial vibe. Like you talk and you like come across as a professor." And then some founders have like more of like a hustler vibe, and like so it's like different for every founder, and there's no like one sort of answer here. But like, what are maybe some sort of patterns of memorable conversations you've had with founders where, regardless of whether or not you invested, in the first 10 minutes, you were like, oh, like, I need to get this person to speak with my team. Like, we should be leaning in here. Like, we want to move fast, regardless of whatever happened with the outcome with the company, whether or not you invested. But like, what are some of those patterns, in the first 10 minutes that sort of really resonated?
You want to start, Paul?
Well, I just think, I mean, I touched on a few of them earlier from my side. I think that you just vibe with certain people, and then also you have a certain feeling about, their interest in the problem, their competence, their ability to execute. There's also been some founders that, interestingly, I didn't like. I did not really like them as a person, but I sense that they were an extremely driven entrepreneur, and I thought that what they were doing was had some value for the world. I try to invest in companies that I think have a positive net outcome for the world, not a negative one. And so we invested anyway, even though like I found them personally off-putting for whatever reason. I'm generally fairly affable, so I can kind of mask it if I find someone personally off-putting. But yeah, it's just, there's some founders you really vibe with, you really like them, you also think they're really competent, and then it's great. And then there are also some founders that like you don't personally vibe with, but you can get past that because you really like what they're doing and you think they're like extremely, like well versed to solve the problem and have the right competence.
Yeah, I would kind of, I mean, I think it's the thing for me is you clearly are incredibly passionate about this space and I'm like learning something, right? Like oftentimes I'm obsessed about this topic and it's really important because of X. And I'd never thought about it that way. Because the best companies, like you usually have a novel take on the world. And so that's what really like draws me in. I will say kind of maybe taking the counter some things that are not great on the first 10 minutes. Full stop, anytime you have three or more people on the call, like your team should not, and I typically I'm typically pretty anti even having your CTO on. Like we've invested in some companies, there's always exceptions, but that CTO's time is so much more valuable coding than being on a first investor call. So to me, it just shows, again, as a general rule of thumb, not a great use of judgment. Again, there's always exceptions, but like I'd really be thinking if you want to put your CTO on first calls. In general, I don't think that math works out. Um, Another thing that we haven't talked about, just to put it out there around your off-putting topic, Paul, is we haven't talked about what happens when we pass, because we've passed on companies and we've invested subsequently. And so I think that's another really important thing to think about. And I can think of one company that I had initially passed
We
on.
never pass. We just have some issue going on that prevents us from investing at that moment in time. Usually it's our fault, because you always want to have the option to reinvest. So like I
Yeah.
always tell founders that we're just, something's going on, we're unable to participate at this time, which is usually true. I mean, there is always something going on, but it's, I know some VCs where they'll pass and they'll give the founder the full essay on why they're passing. I'm not that person. I don't think founders appreciate that. I didn't appreciate it as a founder when I was racing.
Yeah.
And so I prefer to be the VC that's like, I like you. It's not going to work right out right at the second, but like we'd love to be supportive, helpful, and next round might work out.
And I'm actually the opposite. So I can think of one example where we passed and this was a team that jumped off the page. I mean, talking about like you could get that it was really high functioning. The idea just was not there. And so this is one where I was super explicit, you know, we love you, we love what you're building, we love this space. We just can't get there because of these very specific things. And to their credit, they came back 2 months later and said, we went out to market, we tested all the things. You were right about these, we pivoted here. We think you're wrong about this. But like I love the fact that they came back, they gotten data, they executed and they updated me and we ended up investing and that investment has done very, very well. And so don't especially, and this was one where they had a little extra something. I reached out and passed on a call, like very explicitly walk through why. But especially if an investor takes the time to jump on a call or to give very detailed feedback around why, that's often a signal that like we're leaving the door open for you to disprove us and come back and we'd love to re-engage.
Yeah, no, this is an excellent point it's a great point. We are running out of time. I'll take one last question before we wrap up here. So Cameron, I think this one's for you. You mentioned, our email boxes are open, cold email works, LinkedIn works, Twitter works. The question here is, given the volume of founders who reach out asking for 15 minutes, how do you decide which conversations are worth taking? More specifically, what separates the standout reach outs from the rest?
I would say it's one, it fits our thesis area because we get a bunch that just don't, right? Whether it's geography, what they're building, stage, etc. Um, Outside of that, it needs to be really novel because we'll get a ton of AI for whatever in financial services, and we're getting that through kind of our own networks where they've been validated. And so if it's coming in cold, it needs to be a totally different take on the market in our thesis area where it feels like the right team, but like your idea needs to jump off the page that much more. Um, and that's what will cause us to kind of reach out and actually schedule time.
Awesome. That's great. And I think there's one, well, I think we're right on time. Well, Paul, Cameron, this was great. We're getting great feedback on the forum. I think I learned a lot from this conversation. It's been phenomenal to sort of have these very different sort of focus areas for two firms sort of come together and talk about some of these things that just helps, bring founders and investors closer together. And so, that's our mission at Metal. That's, a big part of why we started Metal. And so thank you so much for being with us and for all the insights. And we look forward to continuing the discussion and being in touch. Paul, Cameron, thank you so much.
Thank you. We're excited about what you're doing. So keep up the good work too.
Awesome.
Thank
Thank
you.
you. Thank you, everyone. Thank you.